All right, so we are recording and we are live. Um, I hope last week's Zoom meeting was helpful. More digging down into the problems and showing you the calculations. And I saw that a lot of you actually got the assignments in early, so that was appreciated. And I hope that you found it relatively easy. But if not, I can try to make some time to do one-on-ones. So just let me know if you want that. I know a few have already requested that, but I'm hoping that we can nail out or iron out a lot of the wrinkles here with the extended Zoom periods that we have. So next week is going to be the midterm exam. I will hold a Zoom meeting next week, and we can, do a review, and not to worry. I mentioned to most everybody in the grading that I won't have some of those sections in the exam because I didn't, wasn't able to cover them in a full lecture type setting. So I'll make it difficult enough to where you'll have to use the book to get to the answer, but most of the answers you'll be able to get to just by reading the chapters. So and then I'll have a couple of questions that go into the Excel build. And if you're not using Excel, I'll have you answer the question outright by hand. So it's just more practice, and the two exams themselves are worth 100 points altogether. So most of the grade's going to come from your homework and the discussion questions. So the second discussion question is up. I'll put up a third one after this one closes, and I'll just keep the same format. We'll just try to get a conversation going about what the future holds for some of these aspects that we're learning in this class. This second discussion question goes into the future of funding, and there are a lot of different angles being created all around the world right now to make the equity game a little more sweeter, and I mean that by it's not just money that's given now for equity. You can give consultation for equity, or something of value for equity. So there's a number of games that you can play that would be beneficial to both parties. So it's not just about giving out a percentage of what you keep versus an infusion of cash, which it usually is. But we'll get into all that later on. Let's go right into the modules here. Right, this is week 6, so it's flying by. I graded 3 and 4. Discussion question 2 is due tonight. Time value money is going to be used in every single chapter from now on, so it's important to be able to build what we learned today into that solving for financial equations, because today we're gonna learn about what actually goes into making that interest rate. So technically, it's a cumulative effect based on what type of investment vehicle you're trying to create. So we'll get into the nitty gritty when we hit the slides on that. But there is a base, a foundation, which we'll talk about, known as the risk-free rate, and that's just another term for short-term treasury notes. So we'll get into the specifics of why we want to start with the risk-free rate. But you can Google to look at those notes, and it's 1 year or less, and there's multiple short-term treasury notes. So I'll show you which ones to look for. But technically you got that risk-free rate, and then you add in all the risk, which comes with inflation. If you're able to convert that investment vehicle into cash quickly with liquidity, the maturity, how far away is it from maturing? So that's a time risk that you're associating with it, and then default. So if it's you know, if there are payments being made that are associated with the interest rate percentage that's being paid out, there's a risk that you could become insolvent and not be able to pay those payments, which means there's a default risk that could happen on any investment vehicle. Usually these are private business vehicles and not government. Government has the risk-free rate, so they don't usually deal with default risk. But we'll get into some examples where that might not be true based on our current national debt, which is just it's skyrocketing, and it's concerning us here in Lansing. I'm sure it's concerning all state capitals and even in Washington D.C. But it's like no one's reining in the spending. So it's but that's for another class. We'll just stick to what's in the book for this one, because it's good to know the basics and then be able to think about larger problems through that lens. Excuse me. All right, so let's go right into the objectives. Be able to calculate premiums for a particular rate of interest on various investments. Be able to use Excel to calculate these premiums. Doing by hand is okay. Just take a picture, just like you did last time for the last assignment. You know who you are, people. This chapter is relatively short, but packs in a ton of information. So it's you're able to understand the different types of a risk premium and be able to identify why a certain investment vehicle is that rate of return. So generally, we're trying to figure out the rate of return by adding your risk-free rate to the risk premium, which is divided into all those factors that I just mentioned in the last page here. And then let's get right into the slides. So any questions so far? All right. So this is the cost of money. Can be describing the cost of money and factors that affect it. Kind of briefly went into that already. Describe how interest rates are determined. This is important because if you yourself are going to create an investment vehicle like a bond or do price discovery on a stock, as a financial manager, you need to know how to do these things. Describe yield curve and how to forecast the yield curve. This year, we finally hit an inverted yield curve, and I know my colleague over there in the economics department, Jerry, he's been really keeping up to date with what's going on in that field. But we can look into how a yield curve is created. So that part's important because it has to do with maturity risk and from short term to long term, how much time goes by and how much quote unquote money is that worth. So if I'm going to have to wait longer for my money, I want more of it, and that's the general gist. And then also, from what we've learned previously, the higher the rate of return is, the riskier that investment vehicle is because it has all these associated risk premiums attached to it. Discuss how government actions and general business activity affects interest rates, and describe how changes in interest rate return affect values of stocks and bonds. So this is going to be the chapter after the midterm is going to go into valuation of bonds and valuation of stock, and we're going to be able to incorporate both the creation of an interest rate and time value of money into solving equations for things that most of us probably already look up every day by looking at some of the stocks that are available on the market. But later in the class we'll get into private equity firms that haven't gone public, and what their obligations are, because they don't have to report to a specific they do report to the SEC only after they reach certain thresholds, like 100 over 100 shareholders. So just because you're not traded publicly doesn't mean that you don't have equity stake, and another name for that is equity share. So here is the formula you want to get to know the most in this chapter, and that's going to be your yield formula. So just keep this part in mind here in the parentheses, your ending value minus your beginning value. So this is saying if I buy a stock for X and then the value goes up by 10 over 2 years, then it's going to be X plus 10 minus X, if you're thinking about it in algebra. But we'll get some actual numbers and specific ways to work these problems out. But then it's ending value minus beginning value over beginning value. And this dollar income here is always associated with either a dividend that you get from a stock, a coupon that you would get from a bond, or an equity stake you would get from a VC funding venture. So factors that affect the cost of money are production opportunities. So that's always, you have a choice of a project and you're going to choose which one is best for your organization. Time preferences for consumption. So we always prefer money sooner. And if we have to wait, we want to add on a maturity risk premium to that. Risk in general is what's the likelihood that I'll get the amount of money that's being offered. And then inflation, from our economics class, and a lot of the headlines that have gone viral regarding our president and the chairman of the Fed, Powell. We're trying to keep inflation low at this point because we're unable to raise interest rates above a certain level without, causing the stock market to kind of say, hey, what's going on here? What are you doing? We want to make money, but we also want money for free. And I'll tell you exactly what that correlates to here in the next couple of slides. So interest rate levels in general. This is showing a market for like a money market, and there are a number of investment vehicles available for there's a certain amount of these available based on bottom lines of companies. So low risk securities, generally the lower the risk, the lower the return. So you're always going to have a return that's going to go from between 0 and usually 5%. But even now in the United States, 5% is a nice return for street level investors, meaning people that don't know what they're doing. But in general, the higher the rate of return, the higher the risk. So this is a market supply and demand market. saying that if we supply at this level, we're going to get relatively steep. You can tell by the steepness of these curves that the risk premium has an effect on whether or not you'll get that amount of money in the end. So the biggest takeaway from this graph is going to be if you need, yeah.
You guys need any medicine on tonight?
No, thank you.
Okay, thank you.
Yes, yes, you too. Yeah, I know. All right, so where was I? Okay, yeah, higher the rate of return, the more risky it's going to be. So we'll get into that actual calculation here. And then the lower the rate of return, the closer you actually get to the risk-free rate, which again is short-term treasury notes. So this is general. Blue is long-term rates. So those are going to be your 30-year. Sometimes they include 10-year in there. And then the red is going to be your short-term rates, and those are year or less usually. So definitely look to see if there's any small writing underneath any of the investment vehicles that you're looking at. But the red bars here are inflation. So meaning that a certain amount of percentage of the total money supply was added that following year. So these percentages are saying compared to 1989's money supply, 6% was printed by the Fed and added into the circular flow. The blue are recessionary periods. So this was savings and loan. So this was a big debacle back in the early 90s. So that was, you're always going to see this decrease in short-term rates directly after or right in the middle of a recessionary period. This was 9/11. So we had a major, we lost the Twin Towers, and that was a major global trade center where a lot of money was trading hands. So we had to be able to accommodate for that loss by lowering the rate instantly, because all of our, people consider the USD a safe haven, so they're always going to invest in an investment vehicle that will have a positive future, present value of future flows. So it's all, I'm going to try and, build everything that we're learning, try to do this comprehensively so you guys can understand. I hope that I do a good job with that, but just let me know if you are confused. And then the latest catastrophe was the subprime mortgage crisis. And as you can see, since then, through rate control and quantitative easing, money has been free. So this is your risk-free rate is below. So this is 1% right here. But we're talking, it was below 1/4% for a long time. And what does that mean? That means that you're able to borrow a lot of money without having to pay more than 1% of interest on that. So if you're borrowing hundreds of millions of dollars and you only have to pay 0.25%, then you're in a situation where technically money is being traded around for free. But on at the same time, what it does is it gets so many businesses so leveraged, meaning that they borrow so much to get their cash flows going, that once interest rates start to go up, it's going to completely skew that model that they had built by borrowing the free money. So, and it's, 2019 now, rates started to go up a couple of years ago, but we as an economy ran into a wall because we still have, like, when you guys get into the Federal Reserve with your economics class, we still have all of those assets on the balance sheet. So they're not keeping in mind that we did all this quantitative easing, meaning printing money, lots of money, to be able to keep the circular flow going by lending it out at a very, very low rate of interest. So that's kind of, I can go on all day and do a rant on that, but I won't. We're going to keep on going. All right, so here's a good way to look at it. You got your risk-free rate of return, and then we want to add in the premiums for the risk. So the higher the risk, the higher the rate of return. So determinants for market interest rate, the rate of return is going to be equal to your risk-free rate plus your risk premium. And you'll find this notation in the book and in some of your problems. So the risk-free rate plus the risk premium, and the risk premium is default risk premium plus liquidity premium plus maturity risk premium. So these are important to know, but don't let them get you confused or thinking. It's really just the risk-free rate plus the risk premium, and then your rate of return is your quoted rate, like we learned a couple chapters back. So real versus nominal all has to do with inflation premium. So let's R is equal to the nominal rate of any investment, which might include a risk premium. So nominal is kind of the base. It's not completely accurate, but it'll get you into the right ballpark. And then you go on to the risk-free rate of return, which does not include inflation. So that's saying right now you can get short-term treasury notes for, X percent rate of return, risk-free rate of return. So then the nominal risk-free rate, which includes an inflation premium that is equal to the average inflation rate expected during the life of the investment. So we'll get into how to calculate that, because sometimes it can be confusing, but we'll go into some of the more complex calculations here, so you guys shouldn't have a problem with the homework. But again, email me if you do. So this is there's a formula that you'll look for. This is your nominal rate, your quoted rate, your APR. This is your risk-free rate, and that does not include inflation. And then you include your risk premium, which for real rate would just add in the inflation premium. So it's saying, okay, so if I get that treasury note for a year, how much inflation is going to happen over that year? And then you build that into the problem. All right, so premiums added to R for different types of debt: inflation premium, default risk premium, liquidity premium, maturity risk premium. These are the notations for them, so you can, I'll show you how I put it into a spreadsheet, so you'll be able to, keep track of where you are in each calculation, because you kind of have to do arithmetic on all of these and algebra. So it's good to, kind of space out each move that you're doing. And I'll show you how to do that on Excel. But these are good problems to do by hand too, but you don't have to, because, it's a lot of writing. All right, so premiums added for risk-free rate for different types of debt. So this is an important piece because this will show you what kind of investment vehicle you're looking at. So short-term ST Treasury only has risk premiums that have to do with inflation or short-term inflation. So that means just for that 1 year, how much inflation am I going to be exposed to at the risk-free rate? So long-term Treasury, and Treasury means that you're not getting it out of a business, you're getting it out of the government. Long-term Treasury, you have to account for the inflation premium and then also for the maturity rate premium because you're dealing with time. So if it's long-term, that's a year or more. So each year that goes by has an associated maturity risk premium, meaning that you might not get to the full amount of money by the end of the term. So that's why you add in the maturity risk premium that accounts for time. So short-term corporate, so compared to short-term treasury, where you only have inflation premium, short-term corporate has inflation premium. It has default risk premium, and it has a liquidity premium. So that's saying how much inflation am I going to be exposed to in this 1 year or less corporate bond or stock or whatever. What's the default risk premium, meaning does the company have enough money to pay its bills? So if they're offering a certain percentage on a bond, but they don't have enough in their retained earnings, they have a risk of defaulting. So you won't get that payment. And then the liquidity premium is saying, can I turn this corporate bond into cash quickly, or do I need to hit a secondary market and put in a sell order, which takes time, or am I able to convert it into cash automatically? So that's why we see these options now, conversion to stock, conversion to cash kind of deals. And then long-term corporate is exposed to all of them. So inflation, default, maturity, and liquidity. So in short-term corporate, you get rid of the maturity because you're only exposed to that 1 year of inflation. But then also with corporate, you have risk of defaults, and it's harder to change into cash than treasury bonds. All right, any questions on that? Let's keep going. The term structure of interest rates. So term structure is the relationship between interest rates or yields and maturities. We try to depict this in the yield curve. So you'll see a lot of this. You'll even see some of this in the Treasury web page, so treasury.gov. And I'm trying to remember the Treasury Secretary. Oh, Steve Mnuchin. He's this Treasury Secretary right now, and I believe he was a Goldman Sachs guy and a lobbyist for banks. So he's got good experience in the ecosystem, and I think it's being held together. Considering all of the trade talks going on and instability in globalism right now, because we have more countries than just the United States trying to pull out of these global deals and do unilateral trade agreements. But I know, like in my mom's class, you guys cover contracting, I think. I'm not sure if that's my mom's, but one of the classes for sure. So here is time, so interest rates over time. And 3 months would be closer to the origin on a graph, which I'll show here. So 3 months, short term. And long-term, 20 years. You'll see 30 years a lot in Treasury. So a normal yield curve, you're going to want to see move up. The longer you go, the more risk is associated with it, meaning you'll get a higher return. So yes, this one does flatten out quite a bit, because you can see right here 5% to 5.3%, and then the 2007, which is this green line, it goes down, and then it kind of goes up a little bit, but not much. And then also the 2006. Oh yeah, that was the one I mentioned first. So this is the one that's going up over time, 2008. So this is what we usually want to see. This year we hit an inverted yield curve, which means short term was greater than the medium term, which in hand was also greater than the long term, but the medium term was smaller interest. That's what I'm trying to say. You get less interest in the medium term than you do in the short term and the long term. So inverted also can mean that you have a frown or a smile. So I'll try to get you guys some specific graphs on those later on, but inverted yield curve isn't really mentioned much in the chapter, so we'll move on from that. But just takeaway here is we want yield curves to go up over time because of the added risk premiums. So there are three explanations that shape the yield curve: the liquidity preference, market segmentation preference, theory, and expectations theory. Expectations drives a lot of what we see today. And now I'm getting into that. So liquidity preference, everything else equal. That's just a really kind way of saying, put reality aside for a minute and try to live in this little box. So everything else equal, investors prefer short-term securities to long-term securities because short-term securities are subject to less interest rate risk, thus are more easily bought and sold on the market. And generally that's true. And you'll see a lot of money markets with, investment vehicles that are towards the end of their terms. So this is generally term, and that also goes into the rule earlier on that we want to get our money sooner rather than later. Excuse me. As a result, short-term rates should be lower than long-term rates, and the yield curve should be sloped upward. So that's liquidity preference sloping upward. So you're going from lower left to upper right, and that's kind of this blue one here. But we do want to see it a bit more defined. All right, let's keep going. Market segmentation theory: borrowers and lenders have preferred maturities, generally either short-term or long-term. Slope of the yield curve depends on supply and demand for funds in both the long-term and short-term markets. Curve could be flat, upward, or downward sloping. So that is that's going back to this one here. So supply and demand in the market. Let me find that. So that means you as a financial manager have to search out what the best investment vehicle is for your firm at that time. So that's part of the job, is being able to get the bottom line higher through your investment strategies. Now, expectations is the shape of the yield curve, depends on investor expectations about the future of inflation rates. If inflation is expected to increase, short-term rates will be lower than long-term rates. The yield curve will slope upward a nominal yield curve. So if it's expected to increase over time, that means that, yeah, that means that your long term is going to be exposed to the inflation premium, which is saying that we're adding this IP into the risk-free rate, which generally means that you're going to be going sloping upward because of that. So that being the inflation premium over time increases the rate of return. If inflation is expected to decrease, short-term rates will be higher than long-term rates. The yield curve will slope downward, an inverted yield curve. So this is kind of the where we're saying that the midterm is going to be lower than the short term, and even further, the midterm could be also, or the long term could be shorter than the midterm. So it could be all the way from so upper right to lower left, or it could be like a smile, or it could be you know, kind of a frown where the long term is below the short term. So, but in general, it slopes downward. I don't want to confuse anybody. So just keep that in mind, that your short-term rates are higher than your long-term rates. That's the takeaway there. So forecasting rates, it's what's your inflation premium per year, how many years, and then divide by that amount of years. So I'll show you how to do that when we hit the equation section here. So yeah, the yield is a accumulation, so a summation of rate on year one plus the rate on year two plus the rate on year three, rate on year n divided by that amount of years. So again, I'll show you guys how to do this and how you should kind of, you know, spell it out in Excel so you can keep your mind you know, active in regards to which step of the process you're on. So risk-free rate plus inflation premium, and then you add in your risk premium here, which is default, liquidity, and maturity. So here's an example. Expected annual 1 year inflation rate. So on year one, it'll be 2%. On year two, it'll be 4%. On year three, it'll be 6%. So the inflation premium on year one will be 2% divided by 1 because you only have 1 year. So the inflation premium on year two is your year one rate plus your year two rate divided by 2. So 6 divided by 2 is equal to 3%. And this is your, what this is equaling is your inflation, expected inflation based on your expected inflation rate. So you have to, so this is kind of taking how many years that you're expected to have inflation divided by your expected percentages. So for the third year here, it's 2 plus 4 plus 6 divided by 3, which is equal to 4. So I'll show you what these numbers mean as we go on here. Suppose the real risk-free rate is 3%. Inflation premium, average expected inflation, and then the nominal rate for each type of bond is added together. So a lot of the work you'll do in this chapter is arithmetic, or adding and subtracting. So that's why I say don't let it stress you out, because it's as soon as you see me work through some of the problems, you'll be like, okay, that's pretty easy, and I hope it is. I hope. Other factors that influence interest rate levels. Federal Reserve policy, of course, that's monetary policy. That's what the discount rate is for the entire system. So that plays a part in setting the risk-free rate. Federal deficits, so that's okay. So you have your debt and your deficit. The debt is all of your deficits added together from 1776 until today, where your federal deficit alone is 1 year, and that's 1 year of revenues that you bring in, and then you subtract expenditures that you pay out. And we have been spending more than we make for nearly 2 decades now. So it's getting out of control. International businesses, foreign trade balance. So that's exports minus imports, if you're looking at it from the home. And then, of course, business activity within a jurisdiction is your GDP. Interest rate levels and stock prices. The higher rate of interest, the lower the firm's profits. So that's because they're paying out more. Interest rates affect the level of an economic activity. Oh yeah, interest. So that means that they're having to pay more for the money that they borrow. Excuse me. Interest rates affect the level of economic activity, and economic activity affects corporate profits. Hands down, the more transactions that we can have take place, the higher the possible GDP. So that's where, like, transportation infrastructure, digital infrastructure, and a lot of these other final product infrastructures come into play when we're trying to increase the GDP. So it's not as simple as tax cut or stock buybacks or something like that. All right, this is the last slide here. Then we'll go into some equations from the end of the chapter. So cost of money as a determinant of value. This is the kind of equation I'll want to see if you're doing these complex equations by hand. So the hat on top always means expected. So that's the guess before it happens. And then we're always, later on when we get to another chapter, we'll compare it to the actual. So, and then it's that difference that can also go into risk profile. So that's, it's an important formula, but just keep in mind that we're pretty much using similar formulas throughout the class, because you're always going to have 1 plus your rate to a value of time, and then whatever that cash flow or payment or future value, present value is. All right, any questions on the slides? All right, let's get right into it, and then we'll see if we can't. Let's see if it's loaded. Yeah, it's loaded. All right. All right, so we're actually doing number 1, so let's go on to number 2 here. So 1 year ago, Richard purchased 40 shares of common stock for $10 per share. During the year, he received 1 dividend payment in the amount of 50 cents per share. If the stock is currently worth $9 per share, what yield did Richard earn on his investment for the year? So let's do number 2. Remember the formula that I said went over earlier. So ending balance minus your beginning balance, and then plus dollar income, which is in this case will be the dividend, and then divide it by the beginning balance. So always write down the formula before you engage with it. So I would say, since that's 40 shares of common stock, we're only going to use the values here, the 50 cents, the 10, and the 9. And to be able to do that, we're going to say equals, so the ending balance was 9 minus the beginning balance, which is 10, and then plus let's see here, 50 cents or 0.5. And then I always split it up, because if you try to do the divided by the beginning balance there, you'll have to, use parentheses and, do it in a way where you could lose a step. So I like to do the denominator in one cell, and then I do the complete question in the following cell. So what do I mean by that? Let me just show you what I mean. So we're going to divide the numerator by the beginning balance, then we divide by 10. And then, okay, so always convert these to percents and then bump it over twice. So what yield did Richard earn on his investment for the year? Negative 5% yield. All right, let's keep going. Let's do number 3. 1 year ago, Regina purchased $10.50 worth of Elite Electricians common stock for $42 per share. During the year, Regina received 2 dividend payments, each equal to 5 cents per share. The current market value of the stock is $44. What yield did Regina earn in her investment? So again, we have a beginning balance, ending balance, and dollar income. So let's go with same, and I'll just always do this, so I know what formula I'm using here. So now it's a little bit different than the other one, but you have, so ending balance was 44, beginning balance was 42, then you add, we have 2 dividend payments of 5 cents. So double, yeah, they'll always ask you if you want to, when you're breaking it up into separate thought processes instead of doing it all at the same time, they'll ask you if you're okay with it. So 2.1 there, and then we want to divide it by the beginning balance, which was 42. And then convert it to a percentage. So Regina made a 5% return on that investment. So the difference between a negative and a positive return. Oh, see, I just went and did it. All right. So keep that numerator. So these are the numerator. Here, I should have done this originally. All right. Any questions? All right. Let me move on to like number 5 here or something. So yesterday, Sandy sold 1,000 shares of stock that she owned for $45 per share. When she purchased the stock 2 years ago, Sandy paid $50 per share every 3 months. During that time, she held the stock. Sandy received a quarterly dividend of 50 cents per share. A total of 8 dividends were received. What return did Sandy earn during the 2 years she held the stock? The price of the stock was $45 per share 1 year ago. What return did Sandy earn in each year she held the stock? So this is kind of, now it's digging down saying, all right, now we're going year by year. We got multiple dividends. So how does that calculate? And again, we're going to use the base formula here, but we're going to do a couple of different things. So let's see. First thing we're going to do is the numerator. So equals. So this is going for A, which is what is the return Sandy earned during the 2 years. So we have 45 ending, 50 beginning, and then we're hitting a plus, and then that's 50 cents 8 times. And then again, solving the beginning balance was 50. We're at 2%. Bump it over. So now let's move on. And now we're going to go. So that's negative 2% yield over 2 years. And that includes the dividend payments. And that's because the stock price went down from 50 to 45. Now, let's see here. If the price of the stock was $45 per share 1 year ago, what return did Sandy earn each year she held the stock? Okay, so now we're saying so from the first year 1, we went from 50 to 45, so ending minus beginning, plus, and then we only had the 4 dividend payments. And then equals here. Let's see. Sorry about that. Here we go. And the beginning, again, was 50. So you're dividing by the beginning here. And by all means, you can build this into a solvable equation, go ahead, but I like to show you how I break it down into separate calculations. So this is definitely a long-handed way of doing it, but if you can get to the same result by typing it all in at once, go ahead, that's fine. I just want to be able to click on it and see what you guys were thinking. So year 2, that was, there it goes again. So that's saying if the price of the stock was $45 per share 1 year ago. So that means our beginning and ending balance was 45. And then we add in the dividend payments. Whoops, that's not right. That's going to give us the negative. There we go. And we're going to set that equal. And then divide that by your beginning balance, which is 45. All right, any questions on that? That one's a little bit more difficult, but you'll be able to go through this video and see how we got there. Just remember the ending minus beginning plus your dollar income divided by your beginning. That's pretty much what I'm breaking into 2 pieces here, but don't let the numerator confuse you about solving for the actual percentage. All right. Number 7, suppose the yield curve on a 2-year treasury bond is 5% and the yield on a 1-year treasury bond is 4%. If the maturity risk premium on these bonds is 0, what is the expected 1-year interest rate during the 2nd year? All right, so it's asking us about a rate during a period of time. So to be able to calculate for that, we're going to put in what we know. So let me get rid of this. All right. So the 2nd year, that's different. I mean, year 2. Yep. A 2-year treasury bond is 5%. So we know that it's equal to 5%. And that's from taking it right out of the question. So 5%, 2-year treasury. So year 2, the rate is going to be 2.05. Always put it in a decimal. Always, always, always. And then what we're trying to find out is, remember from the slides, divided by 2, since we have 2 years. So rate 1 plus rate 2 divided by 2. So that's the formula that we're going to use. So what is this equal to? That's the question. And that is, we already have two of our rates here. So 5% is equal to 4% rate 1 plus rate 2 divided by 2. So so that's why I like breaking these down into solvable equations in more than one step, because you have to think beyond, you know, um, the rates you're solving for and the rates that are stated. So you have to think beyond that, and I encourage all of you to write it down as such. So again, that's going to be, so 0.05, which is our 2-year treasury bond rate, is equal to, rate 1 is 4%, plus rate 2 divided by 2. Now let me get that into a single cell here. So now you solve for R2. So get rid of the denominator and then get R2 by itself. R2 equal to 2 times 0.05 minus 0.04. So it's all algebra. That's what I'm saying. You can't just intuitively think it through. You have to calculate. All right. So as soon as you write it out, then, only then, do the calculation. So now 2 times 0.05 minus 0.04. And then convert it to percent. And that is going to be the interest rate during the second year. So if combined, year 1 and 2 together get you 5%, what plus 4% over 2 years will get you to 5%? So that technically you can say that 10 minus 4% is equal to 6%, and you get to 10 by multiplying 2 years by 5%. So there's multiple ways to do it, but this is the long-winded way, so you guys can do this longhand first, and then you'll learn shortcuts as you do more. But always learn how to do these longhand for sure. All right, any questions? So remember to break it up into steps. You know, and we're doing algebra here, so just be aware of that. All right. Let's do number 8. The interest rate on a 1-year treasury bond is 1%. The rate on a 2-year bond is 0.9%, and the rate on a 3-year bond is 0.8%. Using expectations theory, compute the expected 1-year interest rates in the second year and the third year only. So we're kind of doing this, but with multiple years, so more than 2 years. So you're going to want to write out your rates. And then you want to write out your formula. So if you're trying to find year 2 and year 3 only, your formula is going to look like this. So there's your rate 1 plus R is equal to your 2-year rate. These are your by-year rate. These are your cumulative rates. All right, so let's keep going on this gravy train and make it happen. So get R2 by itself. I always write it out before I actually do the calculation, so I don't mess it up. And then do the calculation. So it is a little redundant there, but it helps me each time to make sure I'm doing it right. So now you can say to yourself, okay, so 1% plus 0.8% divided by 2 is going to be 0.9%. So that's the thought process there, but this is how to do it longhand in work. But now if you add in another year, you're going to look at an equation that looks like this. You always start with your first rate. And now that we have our second rate, which was this one, always add in that and then plus R3 divided by 3 is equal to your 3-year rate. And then get R3 by itself, do the algebra on it. And then when you do the subtraction piece of the equation, you're going to want to do, remember how I kind of did that thought experiment in between? You're going to want to say to yourself, all right, so how much am I subtracting? I'm subtracting the 0.01 plus the 0.008, so that 1.8%. Now, open up your, and then solve for it. All right, and that's going to be your R3. So that's the rate. That's the year 3 rate on a 3-year bond. So that's how you want to think about these things. This is a year 2 rate on your 2-year bond rate. Okay. Any questions on that? Because that can get confusing if you're thinking that your 2-year rate is the same thing as your year 2 rate. So it sounds alike, but they're different. Your 2-year rate is year 1 rate plus year 2 rate. Okay. Moving on. Let's try a little bit harder here. We'll do number 12. The rate of inflation for the next 12 months is expected to be 1.4%, is expected to be 1.8% the following year, and is expected to be 2% every year thereafter, year 2. So assume a real risk-free rate is 3% for all maturities. What should the yield to maturity on the risk-free bonds that mature in 1 year, 5 year, and 10 year be? So we have to, this is where we do some adding. So you just got to make sure you're doing the right adding. So what do we know? We have, let's see here. Real risk-free rate is 3%. So we'll do R risk-free is equal 0.3. What else do we have? We have our first year. And our first year inflation premium is expected to be 1.4%. So it's as simple as equals your risk-free rate plus your inflation premium. Whoops. And then here equals 0.03 plus the 1 year inflation premium is 1.4%, 0.014. So some of these are really simple. So don't let the wording knock you down. So 4.4% on the 1 year. But now building in the 5 year, it's a little different because you have to be able to account for the changes in the inflation expectations year over year. So technically you're doing y1 plus y2 plus y3 plus 4 plus y5 divided by 5. That's what you have to do. So let's do that. Right to the answer board here, we'll do equals. So year 1 was 0.014 plus year 2 was 0.018. And these I'm getting right out of the question. And then 2% for every year after that. So plus 0.02 plus 0.02 plus 0.02 to the 5th year. And then divide that by 5. Whoops, what did I do here? Oh, right here. Plus. So now we're saying, okay, now I need the risk-free rate, which is 0.03, plus my risk premium. So it's really, as soon as you start doing these, they do get simpler. And then so that was long-handed. You could have done 3 times 0.2, and I'll show you that you should do that in the 10-year. So that's just, same as above here. You add them all together and then divide by 10. But to do that in an equation, you can just do 0.014 plus 0.018 plus and then 0.02 times it by 8. Oh, excuse me. And then divide it by 10. You always divide it by the number of years. So, and then we do equals risk-free rate plus the risk premium. And change it to 1% and bump it up. All right, so it's a little more complex, but just watch that part over and over, and I'm sure you guys will be able to just, knock them out. All right, let's do a couple more, and then we'll call it a night. Number 16. Well, if it loads, okay, it loaded. Very good. All right, suppose today is January 2nd and investors expect the annual risk-free interest rates in 2023 and 2024 to be 4.5% in 2023, 2.3% in 2024. Currently, a 4-year Treasury bond that matures on December 31st, 2022 has an interest rate equal, to 2.5%. That's important. What is the yield to maturity for the excuse me, yeah, treasury bonds that mature at the end of 2023 and 2024. So now we're asking, okay, so we're trying to project a little bit on this one. So we're going to year 5 and year 6 based on information that is 2022 is after 4 years. So we're getting kind of to the point where we need to do a little bit more in the calculations. So let's build this one out real quick. So what do we know? We know the 4-year bond has a interest rate equal to 2.5%. So always write what you know down, or 4-year. So yeah, excuse me, when I'm up here, this was a 2-year. 2-year rate equals 5%. 4-year rate, just so you'll see the difference. Yeah, see, now I went and did it. These are all the year the term rates. So 2-year term at 9%, 3-year term at. But I don't want to confuse anybody. This is my notation. You can use your own notation to discern whether it's a term rate or a by-year rate. We'll just leave it at that. All right. So let's go. I'm just going to stick with the theme. So that's 0.025%. And now we can kind of use the calculation. So rate 1 plus rate 2 plus rate 3 plus rate 4, the year-by-year rate on year 4. Is, what's the best way to put this? So divide that by 4 is equal to 0.025%. So we know all these added together divided by 4 equals 0.025%. So what does that mean? That means that all these added together are equal to 10, because 10 divided by 4 is equal to 0.25%. So this is kind of where we're saying, all right, now we have to kind of use intuition in addition to algebra to figure out, where we stand. So we can rewrite this as just copy this. So, doing algebra, you get rid of the denominator. And then this can become one end of the equation. Oops. And let's set that equal to 0.025 times 4. And that's where you get 10. So that's or equals 10%, excuse me. So equals 0.1. And I'll expand these cells here. All right, now what do we want to do? So we know for the first 4 years, we're going to get our rate to 10%. So that's all 4 of these added together is equal to 10%. So to get to the 5th year and the 6th year, we just add in these percents. I know it's like, what? But then you also have to divide by the number of years. So let me just go into it. So now, the 5th year is going to be equal to 0.1 plus 4.5%, 0.045. And then this is going to be divided by 5. me add in the parentheses. Always add in the parentheses, guys, when you're using Excel. You see how that changed because it did the 0.045 divided by 5 plus 1. So don't always put in parentheses. And this is, oops. So 2.9% is going to be your 5-year. So the 5-year bond is a 2.9% as opposed to a 2.5% for a 4-year. And then what else did we have here? Oh yeah, we have the 6-year. So it's equal to, how to do this, we have to add in, so you have your 0.1 plus 0.0, excuse me, 0.1 plus 0.045 plus 2.3%, 0.023, and then divided by the number of years. This is the 6. And that's your, so the yield on a 6-year term would be 2.8%. So that's kind of how you go through these. So just remember to, you can transfer an entire set that's in parentheses onto one side of the equation. So it can automatically like turn into an X. So do a little bit of algebra on that, and it turns in it goes into its own term. So then we use the 10% to figure out the yields for year 5 and year 6. All right, let's keep going. Let's do one more. One more that'll be like one of the end of the chapter problems here. Number 19. All right, where are you? Right here. All right. All right, so suppose economists expect that the nominal risk-free rate of return, R, which is also the rate on a 1-year treasury note, will be 3.2%. Okay. Let me see. Hold on. No, we are doing, I think I assigned number 19. Hold on a second. Week 6. Yeah, I assigned number 19. Let's do number 20. All right. Sorry about that. It's my bad. It's my fault. All right. Economists expect that the nominal risk-free rate of return on a 1-year treasury bond is 2.4% long into the future. General GM, 1-year bond has a yield equal to 4.8%. The yield on the GM bond includes a liquidity premium equal to 0.3%. Suppose the maturity risk premium MRP for all bonds with maturities greater than 1 year is 0.15% per year. Based on this information, what should be the yield for GM's 5-year bond? All right, so there's a lot to break down here, but remember, in general, yield is equal to your risk-free rate plus your liquidity premium plus your default risk premium and plus maturity rate premium. Now we have our risk-free rate is equal to 2.024%. So that's a 1-year treasury bond. So those are short-term treasury bonds are your risk-free. All right. Now what do we do here? So let's look at it year by year here. And we're saying a one-year bond has a yield equal to 4.8%. So to type that out, we're going to want to say 0.048, which is our one-year bond, is equal to the risk-free rate plus our liquidity premium, 0.003, so that's 0.3%. And then plus our maturity risk. On the first year, there is none, so plus 0 on the maturity risk. And then the default risk premium we have to solve for, plus. All right. So since it didn't mention the default risk premium, but it did mention a one-year bond, one-year yield, excuse me, on the bond, we have to solve for the default risk premium. So getting default risk premium by itself using algebra, we have our DRP is equal to 0.48, which is our bond, minus the risk-free rate plus your liquidity premium. So DRP is equal to this now. So 0.048 minus 0.024 plus. And then this is percent. So 2.10% is your default risk premium. Now what do? We got to add that in. So our maturity risk premium now for 4 years. So we have to say, or a 5-year bond. So we're saying that first year there wasn't a maturity risk, but the other 4 years there is a maturity risk at the rate of 0.15% per year. So calculate for that. So we have 4 years with the risk maturity risk premium. You don't count the first year ever for MRP. 0.15%, and that's equal to 0.006, which is 0.6%. All right, now that we have our MRP for the 5 years, now we can start to add in. So we're saying now risk-free rate plus your liquidity premium plus MRP plus DRP is equal to year 5. So now to figure that out, we just, so the risk-free rate is equal to 0.024. Then we add in our liquidity premium, 0.003. Then we add in our maturity risk premium over 4 years. Liquidity stays the same because it'll take the same mechanism to turn it into cash than it would at any point in time. All right, now maturity risk was 0.006. And then we had our default risk here as 2.10% plus. All right. I think I put most of you guys to sleep, but that's 90 minutes. And review this as often as you can, and please let me know if you guys have any trouble with any of the calculations that I made here. So remember to think in a certain way when you're trying to solve using algebra. Any questions before we end the night? All right, very good. Next homework assignment is due next Monday, and discussion question 2 is due tonight by 11:59 p.m. Same format. Watch the video, ask questions, answer questions. All right. Y'all have a good night, and email me if you guys have trouble.